please, if you could take a seat. We are going to start the last session of this conference. Right. And so, after having digged into monetary policy and inflationary shocks and oil prices in all dimensions, after having looked at the global environment, geopolitics of how that feeds into policy decisions and economic trends, now we are going to focus back on Europe and look at whether, so the title of the debate is European Integration and Growth Strategy, Product, Labor and Financial Markets and New Technologies. So we are in Europe with this fantastic architecture, a single market, which is almost complete, a common currency, which is very much complete, and then a strong regulatory framework. And in this ideal environment, and we'll see how far from the ideal we are in the discussion, I'm sure, Europe has a growth performance, a productivity performance, which is dominated by many other advanced economies and also some emerging economies, in particular the US. So we are going to look at whether this sub-performance is due to, incomplete integration, and to what extent, or due to the design with which we've shaped this integration. We have the same time allocation as the previous sessions and the same structure as well. So I will welcome our three speakers sequentially, and then there will be 4 lead questions which will be taken all together before giving the remaining time for Q&A with the room. So let me start with Martin Kocher, who is the governor of the Oesterreichische Nationalbank. He was born in Salzburg, and I'm going to Salzburg every year for the festival, so I feel a strong link already. But before being the governor of the National Central Bank, he was the Austrian Minister of Labor, Youth and Family. I think that was the exact title of your ministry. You have a strong academic background, your habilitation and all the track before this being built at the University of Innsbruck. A lot of knowledge on labor and behavioral experimental economics. I've seen a lot of publications, involvement in editing high-level journals, and a full professor at the University of Vienna. So Martin, the floor is yours for 15 minutes. Thank you.
So good afternoon, everybody. First of all, thanks a lot for having me. It's a great pleasure to be here. It's my first time at the conference. I joined the Austrian Central Bank, the Österreichische Nationalbank, a bit more than half a year ago, and it's great to already know a couple of people in the room, but looking forward to meeting and getting to know much more, actually. I'm talking about structural policies and monetary policy, and you might ask yourself why we're not talking about the current situation. Perhaps some of you might want to talk about the current situation and the challenges we are facing with regards to monetary policy given the price rises in energy prices. I fully understand that. First of all, the program I think was finalized before the 28th of February. Second, I think it's really important to keep an eye on these structural aspects. We have been clearly knowing for, I would say, 10 years at least, probably even longer, that there are structural challenges for the European Union that require structural economic policy responses. And the last 5, 6, 7 years were characterized by covering up these structural challenges and crises acute crisis, actually delaying structural responses in policy making. The more important it is now, despite what is happening outside the European Union, to look at the possibilities to become stronger in the European Union by addressing the issues. And I want to actually focus in the short time I have on two aspects, the European Union single market and the savings and investment union. And I know I'm preaching to the converted here in that audience, but it's still very important actually to look at these issues and actually to repeat it, because I think the sense of urgency to do something has not reached the general public to its full extent. Let me just briefly say that it is, of course, the first mandate of a national central bank to deliver on monetary policy, but without prejudicing this price stability mandate, there's, of course, the possibility to support the general economic policies in the EU and to contribute to the Union's objectives. I think it's even more than that. Central banks have a long-term horizon in their decision making, in their analysis. And I sometimes use the phrase the agent of the long term. Given that central banks are not subject to political cycles, I think it's important for us to engage in a debate on these structural challenges. And let me come to the first aspect, deepening the EU single market. I just show you a comparison between the US and the European Union in terms of trading as a share of GDP within the bloc or within the economic region, and you see that the EU is still quite a bit below the US example. You might know one study that has created quite a lot of attention by the IMF, remaining trade barriers that you can actually infer from the trade flows. And these remaining trade barriers within the European Union amount to about a 44% tariff. So this is the implied tariff. Of course, there are no tariffs within the European Union. It's a customs union for goods, and it's much more for services. In the US, it's much less. That has to do, of course, with different preferences, different languages. But some of these issues could, of course, be resolved. Let me give you just one example to show you what would be possible to reduce these barriers. You can, of course, think of harmonization of laws, of lots of differences, but there are easy solutions. There is, for instance, one proposal that shows you how easy things can be done. And I'm not saying that is very easy, but it shows you how it can be done. Labeling of products. Some people have proposed that within the European Union, there should be a QR code on products instead of the fine print that you can't read anyway in different languages. And the QR code, where you go to a website that gives you the description in all languages, in all legal language of the European Union, would of course create much more competition within the European Union for products, and would perhaps lead to different pricing within the European Union and most likely to the benefit of the consumers. So this is just one example for the convergence. There's of course a lot of aspects associated with regulation and in parts exacerbated regulation within the European Union that doesn't make things much easier. I'm not going to go into detail here. I just wanted to mention here. I think when we go more to the substantial aspects of the European single market, it is clear that there are not that many possibilities for the European Union to become stronger in terms of growth and to become more productive and increase the welfare of European citizens. There is a quote by Pascal Lamy: "We are sitting on a huge reserve of growth at a time when it is needed for the green transition, digitalization, defense, and an aging population." When you think about that conceptually, where are the sources of growth for the European Union? It is the internal market, clearly. it is a possible enlargement. And the third source of higher growth levels is cooperation, partnerships, free trade agreements, and similar agreements, strategic cooperation agreements with other parts of the world, with like-minded countries or like-minded regions, actually. When we take a look at the internal market, clearly there's a lot of things that can be done. Fragmentation remains still very high in professional services, in financial markets, in energy markets, especially the service market I mentioned. It is, of course, an obstacle for many of the general political objectives and the general political targets we have. So completing the EU single market, the internal market, reducing fragmentation is extremely important. I'm not going to go into the details of all these avenues for a fully integrated single market. Let me just say that I think that the 28th regime proposal that has been tabled by the European Commission last week under the name EU Incorporated is a good solution in my view. You can discuss whether it creates additional complexity. On the other hand, it seems almost impossible to converge on the legal framework for companies in due time. So the competition among the national legal regimes and a EU regime is perhaps the best way forward. And even if it is only one step forward, and even if it probably does not contain everything that would be desirable to have in there in terms of tax law, in terms of labor law, there's lots of things you could think of. It is a starting point, and if it works, you can actually extend the setup, you can extend the reach of the 28th regime, and that would help actually, especially companies that grow quickly within the European Union and go beyond borders quickly. When you take a look at these companies, and I'm come back to them, small companies, scale-up firms, they actually encounter much more problems within the European Union than in the US or in some Asian markets. And that is one of the reasons why they often actually move towards other parts of the world and don't scale up within the European Union. And especially in, of course, areas where scaling is so important, digital transformation, AI, you can come up with other examples. This fragmentation is, of course, detrimental to actually creating companies that are growing quickly. So despite having whatever per capita in the European Union, almost the same number of patents than in the US or even more than in China, scaling up is much more complicated, and the legal fragmentation is a major source for the problem. It's of course economics 101. It helps, of course, also the European economic area, the economic policy, macroeconomic policy, but also, of course, monetary policy. If you have more factor mobility that smooth asymmetric shocks in a heterogeneous monetary area, it helps, of course, in the transmission of monetary policy. So there is a clear interest of monetary policy in actually having a stronger single market. And I'm not going to go, in the interest of time, into all the details of these transmission mechanisms. The Savings Investments Union is, of course, a project that all of you know, and I'm not explaining the 4 pillars for mobilizing private capital in detail. I think everybody in the room knows. I still think that the term Capital Markets Union, CMU, is probably the better term than Savings and Investments Union, because we want to have one strong capital market. It is, in my view, a key reform agenda for many other parts of the European Union stronger integration. Why it is key? First of all, it has to do with financing innovation, and innovation is perhaps the most important aspect of growth for a region, an economic region with comparably high costs. We'll have higher energy costs than other parts of the world for the foreseeable future. We have higher wage costs than many other parts of the world. So you have to be more innovative and productive, and financing innovation through a capital markets union is key. But it's also key, of course, for other aspects of economic policy. If we actually want to reach the quite ambitious objectives with regard to energy transition, with regard to climate neutrality, with regard to mobility infrastructure within the European Union, and given the state of public finances in many countries of the European Union, that doesn't allow for much more investments in the short run at least, it's important to mobilize private capital alongside public finances to actually finance these kind of endeavors. Otherwise, it will take much longer. I can just show you a few graphs very quickly to show you the difference. The size of capital markets, US and EU, 12 trillion in US dollars in the EU, 60 trillion in the US. There's much more exchanges in the EU than in the US, and now it depends a bit how you count them. The number is probably a bit exaggerating it, because there's of course links between the stock exchanges, but still. Also, when you take a look at stock exchange capitalization with regard to GDP, 73% in the EU, 130% in the UK, and 270% in the US. Not saying that all that is a target or an objective, but we are clearly having a underdeveloped capital market. And I am not saying that the approach that many European countries with a strong banking sector is bad. That is good in many aspects, but it should be complemented by a strong financial capital market. And you see a couple of other comparisons here: average fund sizes, for instance, IPO volumes, and private equity investments, and you always see that the European Union is not doing very well compared to the US, and this of course is reflected in the hyperscalers in the US. This is reflected in the investments in AI and many other aspects that drive growth in the US at the moment. If you take a look at the additional investment requirements in the European Union until 2030, you see there's a lot of investment requirements. It's not possible to fulfill these requirements with public funds alone. Clearly, this is not going to work. And I already mentioned how important innovation is. When you take a look at labor productivity relative to the US, you see the decline, and that has to do partly or to a large extent with the funding of innovation, because given the number of patents that is similar to the number of patents in the US, it can't be the innovative potential that is missing. It's more or less the implementation of the innovation. Let me just close with a comparison or with a reference to a sketch that I like a lot. You might know the sketch by Monty Python's on the Royal Society for putting things on top of other things. If you don't know that, look it up actually. So what we have been doing sometimes in the European Union is putting things on top of other things. And there's of course always things that have to be put on top of other things, yeah? But I think those two things I mentioned today should stay on the top for some time. They are key for the long-term prospects that we have. Regardless, of course, of the structural policy decisions that are taken not by the central banks, but by politicians, by the Commission, by other institutions, clearly the ECB can, to the full extent, fulfill its mandate. But if structural reform can support the transmission mechanisms, can support the work that we are doing at the European Central Bank, then we are in an even better place than we are now. Thanks a lot.
Thank you very much, Martin. We'll take away this Monty Python Kocher principle for the conduct of implementation of European policies. I give the floor now to Veronika Grimm, who is a professor at the University of Technology of Nuremberg. She is also a member of the German Council of Economic Experts and known for her expertise on energy, industrial policies, competitiveness. So Veronika, the floor is yours for 15 minutes.
Okay, perfect. I chose to draw a little bit the broader picture and then get into some issues that I think are very important in order to get growth back to the European Union. Of course, that cannot be very extensive due to the time constraint, but I would like to remind the audience that we are in a transformation where this transformation of the world order is in a way inevitable. We have since the 1960s seen that the share of the Western world in global GDP has been decreasing. Europe and the United States had 60% of the global GDP in 1916, and today it's 40%. So at the same time, armament, defense spending is increasing, and the purchase power parity is to the favor of states like China or Russia, for example, who get much more defense capability or offense capability for the dollars spent. So this is a very challenging environment in which the European Union is under quite some pressure to just speed up growth. Growth has not been there in Germany for a while, has been slow, moderate in Europe, and has been more dynamic in the US. So that's a challenging situation, and at the same time we see that now also in Germany the industrial production is decreasing. So what we earned what we got our growth with, the exports of machinery, of cars, and so on, is decreasing, and this structural crisis, it has been mentioned by Martin, this has been going on for some time and has been unaddressed. So the German Council of Economic Experts, before I was a member, in the last report, when Isabel and Volker were together in the council, there was a report that really pointed already to this structural challenges that were upcoming and were being seen already. And now you see that the decline of industrial production is there. Europe as a whole does not show this effect, and world industrial production is increasing. And just in order to illustrate the challenge and why it will not be so easy to reinitiate growth in our old growth model, there it's very interesting to look at the production capacity for several clean tech products that are announced in China. So China's normalized to 100% in this graph. And that's PV modules, wind power plants, batteries, electrolysis. You can take also battery electric cars. And they announce massive production capacities for the year 2030. That's what's normalized to 100%. And in comparison, you see what is announced in Europe, US, and for example, India. And there you see that China is covering more than what they need for their transformation. This is the red diamond in the graph. So typically, the Chinese capacities point towards exports. And we in Europe, we announce less, or we plan to install less capacities than we need for our transformation. So this is a challenging situation, and the competitiveness points towards China. There's also the issue of subsidies, but this is certainly a challenging situation for Europe. So what to do? At the same time, we have the demographic challenge. Here, this is the production potential, which is for Germany at the moment very low. It's 0.3 %, and it will even decrease. So in order to reinitiate sustainable growth, of course, we have to increase the production potential, but demographics works against us. So the baby boomer generation will retire in the upcoming years, and this will decrease, so the labor volume will decrease and will decrease production potential. So we have to do something, and the clue is, of course, we have to initiate investments. And ideally, investments not only in some capacities, but in capacities that increase technological progress and make us the technology leader in areas where we have really a technological advantage. I mean, this must be the clue, because we will not do it by addressing the demographic issue. I mean, we can do something to increase labor volume, pension systems, participation rates in the labor market, and so on, but this will not even compensate for the demographic issue, for the effect of the baby boomer generation retiring. So this will be the challenge. So we will have to unleash investments in the private sector primarily, so that we have technological progress and become technology leader in areas where we are unchallenged or have an advantage as compared to China, other countries that challenge us. What happens at the moment is something very different. So we lose employment and value added in the industry, and the employment is going primarily to the public sector and to the health sector. It's understandable that it goes to the health sector because our society is aging. It is understandable that it goes to the public sector because we get ever more complex in our regulation. What you mentioned is exactly the right thing. We add regulation on top, but we do not adjust the whole system so that investment incentives are increasing, everything is well functioning. What you see on the right-hand side is the increase of the share of value added in GDP for services without public services. So some of the economies, for example, the US, where you also have this decrease in the value added in industry, they grow because high-tech services are dynamic, increasing and driving growth. This does not happen in Germany. In Germany, this increase is zero. So Germany is in red, so we have no increase in this share of value added of private services. Others are better than we, but I think we have to do something about this, and this is about regulation. This is about transforming our advantages in research and development, where we are quite good, into value added, value creation, and growth in these innovative sectors. You can illustrate this using some data. For example, this here is the unicorns worldwide, mainly in the US. A lot of companies, also companies that are founded in Germany, are then scaled up elsewhere due to a lot of regulatory issues. It could be that fragmentation is too high. It could be that financing is not available. But it could also be that you have regulatory issues, that you cannot do the things you plan to do due to the precautionary principle in regulation. So we have this trade-off between the risk of a technology, which we address very vividly in the EU, but there's also a risk of over-regulation, of course, a risk to be too restrictive and not be able to unleash the potential of new technologies. I think AI is one issue, so we are very restrictive. We have a regulation, but others develop and regulate afterwards according to the innovation principle and are faster. I think there is a trade-off, of course. That's also a question of risk appetite. But I think we have to readjust our attitudes towards it, and also our discussion in society in order to unleash growth potentials in these areas. Clemens Fuest and co-authors have done a study 2 years ago where they argued that the EU is in the middle technology trap, so we are good at incremental improvements in technologies in the automotive industry and other middle technologies, but we're not so good in high tech. And there are two challenges to this for the European Union. One is that we are doing too much in the middle technology area and too little in high tech. I think this is a problem that also regulation impedes very often, that we can do things in high tech. And then you see in the US that the financing, the investment of the companies in the high tech sector in R&D has been increasing since 2013-14. And in the EU, nothing happened there. So the speed in the US of innovation and of translating growth into innovation into growth is increasing, and we are not coming behind. And I think this is an issue that the European Union should address. One issue is regulation. One other issues, or two other issues, are, of course, that we should care about our education system much more. I think there was damage done in the corona pandemic, but we see that the indicators, for example, here the PISA indicators, they are decreasing, and this is a bad sign. You don't see this, for example, in Asia. And I think we have really to care about the results of our young people in school, but also in apprenticeship and universities, in order to also to speed up the potential growth that we can generate. Last slide. I think a very important issue to think about is the defense sector. We have, especially in Germany, but also in other countries, unleashed a lot of money that is to be spent in the defense sector. And at the moment, what happens is probably not the most efficient and effective use of the money. So the European Union is also in this dimension very fragmented. So we have a lot of different weapon systems in each category. For example, we have 17 battle tanks, whereas the US has 1. Of course, the scale effects that they can benefit from are much higher. We have a lot of developments in the high-tech defense sector that we could potentially benefit from if we use the money accordingly. And we have the tendency or the development that on the one hand, there are these spillovers from R&D investment in the defense sector into the private sector, but we also have the channel the other way around. Today, for example, in Ukraine, there are a lot of technologies, normal consumer products from the private sector being applied in the defense sector. So the innovation chain is going in both directions, and I think we can benefit much more from the need to spend in the defense sector if we understand these channels and spend this money wisely. And then, of course, we have the challenge to integrate here within the European Union to find out how can we enable everyone to spend more in defense against the background of the high debt levels. And these are things that we should definitely talk about in the European Union, and where we have more, should we have more cooperation within among the member states. Okay, so a lot of challenges, but I think we will jointly overcome the difficult times, and I thank you.
Thank you. Thank you very much. A strong discussion on regulation and needs for deregulation on many grounds, and whether or not Europe wants to be at the frontier or to be stuck in the middle, with considerations on defense. Thank you. We now move to our third speaker, who is Luis Garicano, a professor at the London School of Economics, returned to academia after an incursion in the political sphere because you were a member of the European Parliament for three years, right? And your expertise we will see that soon, but your digital economy, productivity, developments, and European institutions. So the floor is yours.
Thanks very much. Thanks, Volker, for inviting me. And I don't know why that's in slide 3. Yeah, because it was passed. It's an honor to be here, and it's particularly an honor to speak in front of Otmar Issing. I'm a big admirer, and I know you're entering your, I think it's 2 days for your birthday, right? For your 90th birthday, so happy birthday. I've spent a lot of time. 29th of March, 1936, that's a while back. I've spent a lot of time in studying your work by working with your student Klaus on our book on the euro, and I'm a big admirer, so big honor. I want to I want to talk about one particular aspect and make only one argument. So I'll be quite precise. I will broaden, and people who follow my Substack, which I profit to announce, Silicon Continent, will know some of what I'm going to say. And the idea is that it's a very simple argument that I'm going to make, which is that the AI revolution is actually could be very good news for productivity and still be bad news for Europe. That's why I'm calling it R without G rather than R minus G. So Europe could import the higher R and not import the G, and that's what I'm going to try to explain and then try to argue what to do about it. And so I hope to give you something hopefully a bit new to think about. So I want to start from a recent paper that Claire and co-authors, Ludwig Strauch, German as well, and Malmberger and Rogny presented. Actually, they presented at Jackson Hole last summer, so some of you have seen it, which had an asset supply and asset demand framework. And they were basically arguing, look, over the 1950 to 2024, we had big increase in asset demand, a small increase in asset supply, and so big increase in prices, big drop in real rates. So basically, the asset demand is coming from what we used to call the saving glut. It's coming from aging populations, raising inequality, and slowing growth. And the asset supply is coming from growth issuance, from government issuance and physical capital stock. So since demand won the race, prices went up and interest rates went down. Secular decrease in R star. Now, the experiment, of course, is what happens now. And what happens now is that we have a big increase in the supply. We have James Bullard was telling us about 2.1%. He was telling us, actually, I remind you his slide, it was second average. Of course, we are probably at peak, I guess, but second average after the Louisiana Purchase and in front of the rails and some other things in terms of the big capital, the Eisenhower highway program, the big capital needs in the US, 2.1% of GDP. Plus, we have 6-7% deficits there. We have our own energy transition. So big increase in asset supply. And at the same time, if the AI boom comes, then we probably need to spend less because we're going to have future growth to save less. So they expect a big increase or an increase in R star. They say, look, if you get a productivity slowdown estimate of since 1950, accounting for a little bit over 1 point, we could have easily that reversal. Of course, for Europe, that increase in R star. For the US, that's not a big deal because the R star comes with a big G. So they get bigger G, they get bigger R, everybody's happy. The investment boom is financed by productivity gains, or at least that's what everybody's hoping in the US as things stand today. My fear is, this is not from the paper, is what is the European scenario in a world where capital markets are global. So people are just kind of sending all their savings to the US. We are importing, as a result, the higher R star. But if we fail on our AI adoption strategy because we want all this sovereignty and because we don't want any data centers in our backyards, Klaus was telling me there was a big data center in Frankfurt that was just voted down because, okay, the neighbors don't want the aggravation. Then we fail to adopt and we get the G flat. Now, R minus G increase, and I don't need to tell in this audience, everybody knows those numbers extremely well, in a context where some countries have very significant debt to GDP ratios, can be very costly, particularly when you add to those GDP ratios big implicit pension debt, which people say, well, you shouldn't count implicit pension debt because that's not real. Well, you know, the politics of the pension debt are real, okay? And we have countries like Spain, like France, like Italy that has four times, 5 times. By the way, the European Commission published until 21 these figures and they stopped publishing them. I wonder why. The question that you will have is, oh, why do you expect a low G? Why do you expect a low G? And I think that the ICT revolution is a worrying precedent, okay? It's a worrying precedent. If you look at the Draghi report, one of the basic graphs, the one with the little bars, and all the bars on the productivity of different sectors look more or less okay. I mean, actually, we don't look much worse than the US, okay? In fact, we look pretty similar. Where we do look much worse is in diffusing and adopting digital technologies. It's really the ICT, and if you close your eyes and you start thinking of all the digital products you use, yeah, we have Booking and we have SAP, and then you stop, okay? There is not much more that we are using. Spotify. Now, the question is, we missed the ICT revolution. Are we going to miss the artificial intelligence revolution? Why did we miss the ICT revolution? And, you know, I was brought up as an economist on the eurosclerosis, and we used to talk about labor costs. And when we used to talk about labor costs, I think we were wrong. We missed something really big. We missed something really big. We were talking about labor cost as a average cost, which, yeah, I mean, you know, you have a higher cost, you take it out on the wage. I mean, yeah, big deal, okay? And a lot of literature concludes with big deal. I think now people are realizing something different, okay? Which is when you have a technological disruption, you have to have the right to make mistakes. When Nokia or when Ericsson realize that they're making a mistake with mobile phones, they maybe need to fire 40,000 people and hire another 40,000, okay? Or maybe 10,000, maybe 5,000, I don't know. They maybe need to flip around, okay? When Volkswagen realizes that IC is not the future and it's electrical cars, and that BYD is one generation, according to a Draghi report, one technological generation further and one cost dimension worse, they are worse, Volkswagen is worse in technology and in cost, then maybe they need to close some plants and open some new ones, okay? But also, when Facebook decides to do metaverse, and metaverse has been a mistake, they've acknowledged it. They suddenly realize we're not doing metaverse, we are doing AI. And they just, boom, they changed around. Coste and Quatalem, who are, I'm sorry I didn't put them there, two economists, venture capitalists, intellectual entrepreneurs who are making more than anybody else to make this point, have a couple of examples about changing the direction in technological companies in Europe with the AI and taking months, years of consultations and trying to make make this new change. Schofer in the Sintra meetings that many of you attended reviews that evidence. So I fear that we will lag again. And I think it's a sensible fear. And it's a sensible fear is increased by looking at AI Act and GDPR and general digital regulations more broadly. There are 270 digital regulations, digital regulators in the European Union, more than 100 tech-focused laws, many pieces of secondary legislation. The full enforcement of the Act is still not starting. We have the market surveillance authorities. You think that Spain doesn't have any AI. Let me take a stone in my own country. We certainly have a big AI authority that was, many cities fought over who was going to get this AI authority. It was really, really contentious. And once it gets there, it has to be staffed with, quote, experts on impact of AI on different freedoms and different rights, etc. Who are these experts? How much do they know of AI? If they know of AI, are they going to the agency? So I fear that the diffusion will be sclerotic and driven by the large incumbents, and that we will not get, that we will do our best not to get that diffusion. More broadly, I think the big lesson that I got out of my stay in politics is that, and these are things that I didn't know, and I bet a lot of the people in this room do not know. One is the precautionary principle we all understand. One realization I didn't have was about harmonization that fragments, okay? It reminds me of the Monty Python sketch, which is putting things on top of each other. I actually haven't seen the sketch, but the title works for what I'm going to tell you. So how will the new stock market authority, the new ESMA work after the package that is being about to be finalized by Council and Parliament and negotiated in trilogue? Will it mean that there will be more power for a central authority? So if you're an asset management from Spain selling in France, will you have to answer the French, the Spanish, and the Europeans more than before, or less the Spanish and the French and more the Europeans? The second is great. The first is bad. The Spanish and the French keep the same power, and we give new powers to the European ESMA. Now, we're not really harmonizing. We're just piling up new regulations on top of the old ones. A lot of the harmonization we are doing works like that, okay? We are putting laws that come in the form of directives that allow for different countries to go in different directions. I'm citing a Christian Lutz, a co-author's piece from 2016, actually showing one particular capital market regulation that after the directive was implemented, the divergence between member states went up rather than down. Germany gold-plated, Romania went in this direction, the gap increased. So we are doing something wrong. And I don't think to go to the title of our session, the completing the single market is not a growth strategy. So what is the way out? There are many things on the way out, and I've been writing a lot, and people who've been will know many suggestions and thoughts, and I am not going to go over those. I'm going to just tell you one very narrow thing going to my AI team. We need to be leaders in AI implementation. I know everybody's worried about strategic autonomy, and everybody here wants to have an LLM layer which is national, which is European. And everybody here wants to have a data center layer which is European. Fine, me too. But it's probably unlikely we are going to get that, okay? So let's lead on AI implementation. Let's make sure, look, it looks like these guys are going to tear each other up. It looks like the LLM players. It looks like this is a very competitive field. We have Quen and the open source coming very close, 6 months behind the frontier. We have the frontiers kind of maintain their competitive advantage for weeks at a time. That means maybe this is going to be a very competitive layer. Maybe the value, like in telcos, right? The telcos don't capture the value came to the software on top. Maybe the value is in implementation. If we make that bet, we need to be fast. We need to embed AI fast in our processes, in our industrial processes, both in the public sector, defense, education. We have a big public sector with a lot of data. And in our private sector, which has a lot of data advantages, from machining to everything in pharma, chemicals, etc. And we need to maintain the other layers interoperable, okay? We need to do like we have done with the directive for financial products, which makes sure, do we have a lot of financial sector innovation? Because we force the banks to make it all interoperable. We need to do a similar thing. 5 policy pillars. For the 5th, you're going to have to wait for my next block, which will come in a couple of days. So the first 4, make sure that we deregulate on adoption. The Annex 3 of the AI Act, particularly all the stuff on the high-risk sectors, is really a big obstacle. The open standards, I was talking about the PSD2 precedents, the same way we force the banks to open the APIs, force the Gen AI companies to have open standards. Build data commons so that we can get the manufacturers to share, the pharma to share data and learning, and we can have some training of the systems from Europe. Oh, that's my own. I am at 15 minutes, sorry. And tax incentives. The 5th thing has to do with mobilizing the public sector in a smart way, learning from Ukraine and learning from China. And I will write about that in a very short time, but I really don't have the time to tell you about it. So the argument is very straightforward. AI has the risk to reverse R star by really pushing risk. It's great, right? The productivity slowdown goes away. Yes, but maybe not for us. Europe might invert the R without inverting the G, and that's a problem. And if we think of ICT and we think of the AI Act, we have a high probability of being behind. And I was suggesting a smart second mover strategy to try to close the gap. Thank you.
Thank you, Luis, for your very concrete suggestions. I suggest you all subscribe to Silicon Continent, to the blog, so that we can follow that in coming days and weeks. And we add to the Monty Python dimension the millefeuille dimension of adding regulations on top of a regulation. So we will come up with a recipe very soon. I give the floor now to the leads questions, which are going to come from Christian Keller. Where are you? You're here. From Barclays. Then we have Jari Stehn from Goldman, Marco Stringa, Element Capital, and Alain Durré from Natixis. Christian, the floor is yours.
Thank you. Thank you for the fascinating presentations. This is about integration and a growth strategy. And I want to bring it back to a topic of energy. And that is not because of the Iran war. It is something that, when you talk to international investors, that comes up over and over, the question of what is Europe's energy strategy. The US has a strategy that declared, abundance of energy, no matter how it's generated, back to fossil fuels. That's their strategy. China, I think Veronika showed in her presentation, they have a strategy of they build out renewables, but make no mistakes, they also build power plants with coal, so do both. They want to have also abundance, even though they know they just don't have oil in their own ground, and they build big reserves. So those are the strategies of the US and China. And I think Martin had in his presentation said energy market as one of the issues, but we didn't touch on it. And I know it's very detailed, but still, I wonder whether you can give us an idea what you think about that part of the equation. And Clemens Fuß from the IFO had an interesting line the other day. I saw it in the news. It said, well, due to our past decisions, and he spoke only for Germany, but energy-intensive industries have no future. Now, I'm coming to Luis. AI is a modern service industry. That's where we want to move to, because a lot of people would have said, well, energy-intensive industries, let BASF move their chemical plant to China. We don't need aluminum smelters. But it turns out that actually the modern service sector is also energy-intensive. So here's my question, to all of you, and I know it's a broad one, but what do we do on energy?
Thanks. I would like to ask how Europe should respond to rising competition with China. So clearly Europe has lost a lot of competitiveness. China is gaining market share. The further increase in energy prices that we are seeing now will probably accelerate that. And this could imply pretty significant headwinds for growth in Europe, maybe also inflation in coming years. It seems the first best clearly is to do structural reforms, boost investment, as you outlined, but that's also very hard to do. So what's the second best here? Should the EU impose tariffs? Should we have minimum price requirements, subsidize industries, or should we simply accept that further loss in market share?
Thank you for the opportunity to ask a question. Great the point about the risk of ending up with higher star and lower G. Martin's presentation started by saying, and Martin is a member of the Governing Council, that condition of the primary inflation mandate, the ECB should try to foster sustainable growth, higher sustainable growth. But what can the ECB do concretely? Let's take the current energy shock. On the one hand, it's not the responsibility of individual euro area countries. On the other hand, some countries are more vulnerable to that shock. Takes, on one hand, Spain and Finland, they did do the homework in terms of energy transition. Take other two countries, Germany and my own country, Italy, they didn't. So I've got two questions. First question, should the ECB, with the TPI, take into account countries that didn't do the homework? It may seem a bit harsh, but the TPI was very good in incentivizing good fiscal behavior. And of course, in the short term, that could be counterproductive because you widen spread. And this is my second question. As a compromise, the ECB could say explicitly or more explicitly that in their policy decision, they will take in consideration financial conditioning tightening. Thank you.
Thank you very much. As recalled by Governor Kocher, we have in Europe good projects on the table, like the banking union, the CMU, and so on, Green Deal. To many respects, those projects are incomplete. On top of that, we have the investment on AI, IT, big data, and so on is really unbalanced across countries within the European Union. For instance, if you look at the latest survey by the IB on investment in Europe, you see that for small SMEs and very small enterprises, 60%, around 60% of survey firms in Europe says that their investment is not related to innovation. It's even worse if you look to very little, very small enterprises, and in some countries like France, although this rate is below 50% for the US. And on top of that, we have also constrained fiscal space at the national level. So then my question is that how concretely, so I agree with your conclusion, but how concretely can we ensure that we have a better coordination at the EU level and between countries to increase further integration and convergence while respecting the national specificities and subsidiarities?
Thank you. So I guess I will give you the floor in the same order as we did before on energy, China competition, country-specific TPI, and enterprise heterogeneous in innovation investment.
Thanks for excellent questions, and it would take probably a very long time to answer all of them in detail. I'll try to do my best to give a quick upshot on what I think about the questions that I'm able to answer. I guess on energy, Veronika, you will say a bit more. Let me just start with the question: what can the ECB do? And it's a very legitimate question. I think, first of all, the ECB, as I said, and that's also true for the central banks, the national central banks, the NCBs, they are a powerhouse for analysis. And I think we have an obligation to provide analysis also for these aspects, and not only for the core monetary policy that we are responsible for. And on top of that, I think that we have clearly times where there is appropriate economic policy responses. When we go back a couple of years, the beginning of the pandemic, clearly fiscal policy was the right policy to respond. When we go back to 2022, 2023, with the price rise in energy prices, monetary policy was the appropriate policy response, and perhaps fiscal policy was not so appropriate at that time. We were thinking, of course, that now, after the recovery, after bringing back inflation to target, it was time for structural policy, and the European Commission started out with a very ambitious agenda. This is now, to a certain extent, of course, made more difficult because the energy price development, the war in the Middle East, deters attention from the structural reform agenda. But still, I believe strongly that policymakers should focus on their policies at hand, and at the moment, of course, it's clearly structural policies for the European growth potential, and perhaps monetary policy responses depending on the development on the prices. Rising competition with China. We have a very interesting analysis at the Österreichische Nationalbank on this competition on imports and the complexity of the goods that are imported from China. 20 years ago, a bit more than 20 years ago, about 10%, 15% of the goods were of high complexity in production, high-tech goods, more or less. Now it's 40%. Yeah, competition has increased, and the first best is clear. That would mean being as competitive. I want to make sure that we're not exaggerating the competition between China and the European Union. There's lots of areas where the European Union is highly competitive. There's a couple of areas, and perhaps strategically chosen by China, where there is much more competition now. Still, I believe, even if you mentioned second best would be to respond with tariffs, I think it makes absolute sense to discuss that on a basis of fair trade and making sure that the imbalances that exist are discussed on the political level, because these second best solutions, we know that lead to, in the medium and long term, to bad outcomes for both sides. Let's see where this is possible, but I strongly believe there is a potential for understanding on both sides. Actually, the discussion that we are very much dependent on China in some areas is one side. If you take a look at the supply chains and some specific products, specific machinery, there is a mutual dependence in terms of what we see between China and the European Union. And so I'm missing the coordination within the European Union. But that was just further integration. I think there was just a argument for further integration. I think there is, Veronika and Luis, they mentioned a lot of aspects. There's a lot of things we could do, and I think we shouldn't be too pessimistic of what can be done. The European Union will always be complicated, that's true, but there are some areas where we're doing very well. And what I think is important, and I agree with you, Luis, in terms of the smart second mover strategy with AI, but there will be a next step of technological change, whatever it is, quantum technologies, whatever it is. I think the target, the positive narrative should be for this next step, there should be large companies that develop within the European Union, and we are on the front of the development, and also in the front of companies that develop and grow within the European Union, and I hope that the basis for that can be set soon.
I think I have to push the button. Yeah, I will take the two questions on energy and on China. I think in terms of energy strategy, it's challenging because we have taken decisions that make it very difficult to now boost electricity supply massively. I think we have an energy transition, for example, in Germany of very different speed. We're very good at increasing renewables and storage, but the complementary aspects, which are network capacity, so grid expansion, and gas. Gas power plants substitute for gas in the medium run, so hydrogen-based energy carrier, renewable gases. Everything is slow, partly due to low acceptance, because people don't want the grid next to their door, partly because of, and also the gas power plants are very disputed, partly due to regulation. It is impressive, the regulation that we created in order to speed up the ramp up of hydrogen. That's so confusing. I mean, we developed a lot of regulation, but we have no hydrogen yet, basically. And that's really impressive. So we have a big project at the moment where we assess this and develop strategies to adjust the complexity of the regulation. But it's really difficult because we have a lot of coexisting measures. So it will be difficult. I think we have to cooperate in the European Union. There are countries that want to develop nuclear and even expand. There are countries that don't do it. And we should at least not hinder each other in developing these strategies, which is happening at the moment. No, we are very skeptical and so on. We should integrate our electricity markets better, and this might require the adaptation of price zones, because the price zones at the moment are not are sometimes disincentivizing grid connections between the member states. Because, for example, Sweden does not want to import the high German electricity prices that just prevail because Germany has one electricity price zone that makes the price in the north artificially high. Yeah? And then the Swedes say, no, we are out. We don't expand our grid in order not to import these high prices more often. So we have some possibilities, and then, of course, the question is, we still, in Germany, I know the data, we rely to 80% on fossil energy, to 20% we have renewable in our primary energy consumption. So we will have to deal with this fossil world for quite some time. And we have to confront ourselves with it, also if the societal debate is not so comfortable as the debate on the transition towards renewables. So we have to have strategies to cope with gas, to conclude gas contracts, long-term gas contracts in order to not be exposed so much on the spot to the spot market prices, which we didn't in the past because we said, in 10 years we don't need gas anymore anyhow. And so we don't conclude long-term contracts. But this is, of course, a disadvantage if you have times of crisis. And maybe we will also not meet this transition path where we do not need any gas anymore in 10 years. This can happen. I mean, the trajectory at the moment looks very much like we don't comply with our own goals. Maybe we get more ambitious or some miracle happens, but I think we have to confront ourselves with the scenarios, and we have also to think about what happens if we don't reach our goals, and this is very important. So it's challenging. We have to cooperate with countries worldwide. We will stay a net importer for a very long time, and I think to quite a big extent. And of course, in order to be competitive also with AI, we have to solve this. Problem. With China, I think it is very important to confront ourselves with the competition. One channel, I mean, you said quite a bit already. Two things that I would like to add is we should try to cooperate in the area of global public goods. when it comes to climate protection globally. China has an emission trading system. We could try to cooperate in this dimension. China has strategies to export its technologies to countries worldwide to give also countries globally the possibility to grow on the basis of sustainable energies. There are a lot of European companies in China that are also cooperating in these activities. So we could try to cooperate with China to lay the ground for more sustainable growth worldwide, to go in the direction of some climate club, to somehow establish incentives for other countries worldwide to join the club according to attractive conditions. So we could try to cooperate there and to solve to focus on the climate transition a little bit more globally. I think this would be advantageous for the European Union anyhow, because if we do it on our own, we get less competitive as compared to other countries worldwide at the moment. No, I mean, they will not follow us. They will not say, that's a good idea. We do it like them, but we have to cooperate globally, and I think China is a good candidate for this. And also, given the aging societies in both countries, I think we could also cooperate in technologies in order to cope with demographic change. So there's scarcity of workforce in both countries. There is a challenge. How do we cope with the aging society? What role does technology and AI play? What is about acceptance of the introduction of technology in this realm? And this can be done together, I think. I mean, that's also not security relevant in every dimension. So this can be done together. I think we should try. And we should try in all these initiatives, we should try to have more exchange at the level of the students. So a lot of technology transfer from Europe and the US to China was done by having Chinese students abroad. So that was a big mechanism of technology transfer to China. They sent their students abroad to the US, to Germany, to Great Britain, and they came back, and today they are professors in China. And we have to do it vice versa. I mean, we always thought, no, we don't need it. We are technology leaders. No, but now they are very much at the forefront in different fields. So we should also agree with them to be able to send our students abroad. It's not automatic. We have to have agreements on this, but I think it would be worthwhile to have more cooperation in areas where it's appropriate and does not contradict our security interests.
So my presentation, thanks for the questions. My presentation was indeed based on the assumption that AI is a big deal. I think that we often, when you hear Commission officials or you hear people in Europe talk about technology, they talk about AI, quantum, I think this is a different thing. I think this is a general purpose technology that the way it looks is like it could really change the world. And it could really append competitive advantages in all industries. And if our industries are basically training on models that are abroad, then their competitive advantages can be gone. So I indeed think AI is a big deal, and it's indeed the case that energy is a huge obstacle in that case. So I agree completely with the question. We are 2-3 times energy costs of the US. And I don't think the debate in Europe, and to be honest, most importantly, the debate in Germany, recognizes that we are sitting on a burning platform here, that where we are is not going to be sustained, that with those types of energy costs, the whole model is not viable. Veronika had a great slide on the potential GDP of Germany. It was like difficult to differentiate the axis from the red line that was the zero of Germany potential GDP. So if we are in a burning platform, then we have to really get more creative about solutions, a bit more bold. And the way I hear the debate, particularly in this country, we are here, so I profit to say it, maybe somebody listens, who knows, is really super conservative. So first of all, out with the biofuels story. That costs a lot of money. Biofuels are not a good way. You convert the sun into corn, and then you convert the corn back into coal. That just doesn't make any sense, okay? It's a very inefficient way to do it. I have a very good suggestion for your hydrogen strategy for your paper. Just one line, drop it. Drop it. Hydrogen's not gonna happen. Okay, Germany is putting a big bet on something that's not gonna happen. So what is the alternative? The alternative is twofold. First, I mean, there has to be some way. I don't believe that there is no way. And if we had a war, if there would be a way funded to restart nuclear in Germany. I mean, the least green thing Germany has ever done is to suppress nuclear. There is now Veronika is telling us about big emissions of fossil fuels. Yeah, no wonder. Just look at the energy markets up, and you'll see how Germany is consuming very much, very much. So if you cannot very much CO2. So if you cannot open the nuclear plants, then Europe needs a small modular nuclear reactor strategy. We need to put them all over the place. These reactors will not cause any accident. The point is, we have them in submarines, we have them in planes. Even if they lose electricity, they don't explode, they don't leak, there's no radiation. So it is a very good idea. We can go there. And I think we need a complete radical change in our energy strategy. Second, on the energy shock and the TPI and so on, yeah, the energy shock is different. Different countries make different choices and they face different prices. Well, too bad. I mean, they'll have to adapt and take the incentives they face. I think TPI, the way it's laid out, at the very least has to be approached with a lot of caution. TPI was the reason Klaus, John Kocher, and me started to write our book on the euro, the Princeton University Press book that many of you might have seen. We were worried, and I am worried, and I was worried that the incentives that are induced by this kind of policy on governments are very negative. And I think it's a risky thing to have this instrument with so vague rules compared to what Draghi put in place with the outright monetary transactions and the whole way that the rescue programs they were structured at the time with an ESM component. Finally, on the small companies innovation strategy, I think the main element that we have seen to get those companies to scale and to enter has been the 28th regime. I've been very negative about it. I don't think I think probably the proposal is not going to work, and I don't think it's going to make any difference. But you don't have to take my word. Other people are in disagreement with me, so I think that's fine. But take the word of the European Commission. They think that the total savings in bureaucratic burden are 400 million over 10 years. Okay, you can buy 3 F-22 planes with that money. Okay, that's the extent of what the savings are. I mean, I don't think that's a significant enough thing. And again, it's the burning strategy. I mean, you can kind of disagree with me, saying, look, you're too negative, and there are lots of good things going on in Europe that are good, and I agree. There's a lot great in Europe. I love Europe, right? But if we don't get a little bit more worried about the future and a little bit more active, we are going to, I think, the combination of the kind of pressures, demographic pressures, energy and regulation and technology is going to give us a future that is going to make our welfare states hard to sustain. So I think we need to start transmitting to our citizens a bit of a sense of urgency. Otherwise, you know, the populist wave will take us all somewhere that we don't necessarily want to be.
Thank you very much. As a French, I won't comment on the nuclear power plant. And as a former staff member of Professor Ising, I won't comment on your view on the TPI, but you have a hint. I take one question. 2 questions, Volker? Okay, 2 questions. Please, so those 2 here.
Harold Benning, professor at Tilburg University in the Netherlands. Thank you for the interesting discussion. Yeah, there's a massive need for new investments in Europe. The Draghi report, defense spending. We also see that a large amount of the funding, the financing, has to be done by the private sector. but still the public sector should in certain cases play a role in terms of initiating certain investments to make the new technologies to make them possible. Well, in that sense, when the public sector has to take a role, there are two issues. We already mentioned high public debt in many countries in Europe, and secondly, fragmentation. The example was given, if things are done at national level, you get like the Germans are buying German tanks and the French are buying French tanks, etc. So fragmentation is a real issue. So one of the avenues here to get out of this is, of course, to move also a lot of these investments from the public sector perspective to a European level. Well, we know that the European Commission can be highly politicized, but there's an institution which has been operational since 1958, and that is the European Investment Bank in Luxembourg. Actually, they started issuing joint European debt in 1959. Well, I come from the Netherlands, and we have a highly charged political debate on so-called Eurobonds, but last Monday, the president of the EIB, Nadia Calvino, was visiting our new Dutch Prime Minister. We have a very pro-European government at the moment. And one of the ideas picking up in the Netherlands, shouldn't we have the European Investment Bank play a much more important role in enhancing this European investment agenda? It would take the burden away from national countries. It would, in terms of their high public debt indebtedness, but also all these fragmentation problems, which are very painful and killing the process. Thank you.
Okay, just a very short question for Mr. Kocher. If you read The World of Yesterday by Stefan Zweig, he's describing the breaking down of the Habsburg Empire because it was so complicated and couldn't adapt to the technological developments in the 19th century. And there wasn't a second chance. And you said, okay, the next time we will have to be better. Are you quite sure that this will work, looking at the Austrian experience?
Thank you very much for the, is the mic on? Thank you very much for the excellent presentations, and I think we all agree that Europe has to get its act together and do something. So I wanted to comment on your final point, and we discussed it already this morning, so I just want to get back to that. I mean, for me, the 28th regime is one of the projects that is key for fostering European growth, by enabling the scaling of companies. I think it's a, I mean, I personally believe it's a decent proposal. It's not a perfect proposal, but it's a decent proposal that deserves our support. So by immediately kind of shooting down something that comes, I mean, I don't think we're helping Europe at all. So you say we have to wake up. I think this is a sign that Europe is waking up and is proposing things that are good. I mean, I'm afraid that the proposal is going to be watered down significantly by the member states. But I think the Commission kind of deserves our support for a proposal that is, I think, reasonably good.
Thank you. So that's it. 2 minutes each to close with remarks, and we go in the reverse order this time. Thank you.
Fragmentation AIB, I will leave for somebody else. I will use my 2 minutes to answer to Professor Schnabel. On the 20th regime and what's the right, so there are two sub-questions there. One is it good or a bad proposal? Another one is what's the right, more constructive way to help make it better? So is it a decent proposal? The proposal has basically, I think, 3 or 4 elements. Let me just enumerate them very, very quickly. I should put my timer. So the first is the registry. It is not a common registry for European firms, but it's a common portal that sends you to the individual registries. We see how that's going to work, but it does have the caveat that the notaries and the judges in the individual member states do. I mean, it's the national law is it's supposed to do within 48 hours, the digital incorporation. It's not really a common single European registry. That's what I'm trying to do. It still goes to the nations and is subject to member state law. The second, I think, interesting thing is the stock option regime. It's indeed the case that private entrepreneurs have been wanting this for a long time. The stock options right now, it's a complete nightmare to pay your employees with stock options, because when you sell, you have to realize the losses, and then you want to invest in the again, it's going to be taxed. And so one thing that this regime does is, in Sweden, they modified that a long time ago. One of the things this proposal does is it says, okay, you can, it's not when they invest when you have to pay the tax, but when you actually sell and you get your cash. So that's a good thing, and it is by unanimity because it's a tax ruling. I don't imagine that this is going to make it to council. If this improvement goes through, it's a good thing, okay? We've been trying to do this since the 90s, so it's going to be a hard thing to do, but it's a good thing. The third is an insolvency regime, which, again, it's not a bad thing that there is a common insolvency regime for these companies that are under this. This is the one case where the proposal talks about scale-ups and startups, but this is the one case where the proposal really is narrowing down the definition to just startups and companies below 100. I am sympathetic to narrowing down certain things so that we can go further, but not by size. Because if you only allow this insolvency for companies with below 100 employees, then any company that really is the one that you want to scale and you're a foreign investor, you want to put tons of money, this is not going to bind. So my sense is, if you think about the key constraints on on the growth of European small companies, which I think have to do with labor law, which I think is untouched, and this is a shibboleth for France, for Italy, for Germany, for our big countries. They don't want to touch this. The possibility, for example, of cross-border hiring. I want to hire somebody in Spain. I'm a German company. I want to have to establish a subsidiary there or pay in some strange way to some strange American company that does these things. I mean, it's really complicated, the cross-border hiring. The taxes, the VAT, it's all incompatible between the different countries. I think when you look at it, I mean, I understand the political constraints, and I want to give support to progress, and I don't want it to be watered down by the member states. My sense, and the sense of the people I've talked to who are kind of thinking of how this is going to progress, is this is going to be, it's a bit like what we were talking about energy before. It's a proposal that recognizes that we need to do something. But as always with Europe, the something is a bit oversold, and the substance is a bit less than, or quite a bit less than what, in my opinion, is needed for a situation which is so critical. The growth is not going to come from the old industry. The growth is going to have to come from these new firms that will scale up and grow and become the big ones. Sorry. Hope it was not too long.
Yeah, thank you. I would like to focus on this need for investments in the EU. I mean, I know that there are a lot of projections how much investments are necessary. And of course, this is interesting and nice to have an orientation. What do we enforce by our climate goals and by goals for digitization and so on? But I think it becomes problematic when you then, from the side of the government, start to decide to implement it by subsidies and to think about, now we know what we need for the next 10, 20 years, and now we have to create a system that spreads enough subsidies to execute. This is, I think, the way to failure, because the subsidy necessary is very, very high, also given the tough regulation that we have. Everything due to a lot of requirements by technology-specific regulation, the projects become much more expensive than they would be if you would have a technology agnostic environment and just, for example, strive for climate protection and strive to reduce CO2. The public involvement, of course, very often makes things very slow and makes cost of failure massive, because typically a public authority doesn't like failure. So it takes a long, long time before you reorient your decision. A private firm would do it immediately. If it does not work what you are striving for, then the cost is sunk, and you just say, okay, then I'm going a different way. And I think this is a very difficult decision that we start to orchestrate our transformation more and more centrally, and then think, we have markets and private firms to execute, but all the private firms depend on subsidies. That's typically not a growth model. I mean, we have to readjust regulation, I think. We have to care for making the projects less costly, by reducing the unnecessary regulation. We have an emission trading system, for example, but we have a lot of additional requirements on our technology transformation path. Why? I mean, that's something that private markets can do perfectly. And this will be figured out if you price emissions. That's the thing. And then you can, of course, have instruments to make it viable for companies that are too burdened by the cost of emissions. I think there are good mechanisms in order to alleviate the pressure if international global competitiveness is then a problem. But I think we have really to address regulation before we say, we have a lot of regulation, we make it very expensive, but then we address this with even more subsidies. We don't have the fiscal space to do it. I mean, that's just the reality.
Very quickly, I try to be very quick. Thanks for bearing with us. With regard to a 28th regime, sorry, Louis, I'm with Isabel here. I think, is it a game changer? Probably not at the moment. Can it be adapted and nurtured to become important in the future? It can, and that's the reason why I think we should give it a chance. But I absolutely understand, of course, that you want to have more in it. As an Austrian, I have, of course, to answer the question regarding Stefan Zweig. Actually, I encourage you to read the book, The World of Yesterday. It's a very interesting book. But the Austrian Empire did not fall because of the complexity. There were other reasons why the Austrian Empire ended, actually. There was lots of complexity and bureaucracy in there, but that was not the final reason. So I ask you to be careful in the comparisons. But actually, the book is really worthwhile reading. Thanks.
Thank you very much. So I want to thank the lead questioners, the speakers, for a very lively session. So I give them an applause, and I give the floor to Volker.